Welcome to the lecture on International Capital Movement. In this lecture, we will focus on foreign direct investment, foreign portfolio investment, types of FDI, advantages, disadvantages of FDI, modes of FDI, and trends of FDI in India. Let's start with the very basic of international capital movement. International capital movement is a part of international business. International business refers to exchange of goods and services, capital, resources, and technology from one country to another. So, international capital movement is a part of international business, and international capital movement is regulated by Foreign Exchange Management Act 1999. In India, the international capital movement is regulated by FEMA 1999. Here, the word capital means money. So, international capital movement is exchange of money from one country to another. Types of foreign capital. Foreign capital means inflow of capital from abroad. First point, foreign assistance. Assistance means help. It is one-sided transfer. So, for example, if grant received from foreign country government, it is called as bilateral assistance. If grant received from international institution, for example, World Bank, so it is called as multilateral assistance. If donation received for specific purpose from abroad, it is called as tied assistance. And donation received for non-specific purpose, it can be used anywhere. So it is called as untied assistance. So foreign assistance can be bilateral assistance, multilateral aid, tied aid, or untied aid. Next, borrowings. Borrowing means loan. Loan received from foreign country government or international institution like World Bank, IMF, ABD. Next, deposit from NRIs. Non-resident Indian is a person who is resident in India for less than 182 days. So deposit received from NRI. Investment in form of foreign direct investment or foreign portfolio investment. Foreign direct investment means investment into the business, and foreign portfolio investment means investment into financial asset. Financial assets are equity shares, preference shares, bond, etc. So let's discuss in detail. So foreign direct investment means investment in real assets of business. Real assets means land, factory, other assets like plant and machinery, furnitures, inventory of business. Inventories means stock, stock of raw material, stock of finished goods. It is called as product of business. So when foreign business organization starts their business in India, it is called as foreign direct investment. What are the importance of FDI? First point is the international trade. At the time of export and import of goods and services, government imposes tariff barriers and non-tariff barriers. But when foreign business organization starts its business in India, there will be no requirement of export and import. Therefore, there will be no tariff and non-tariff barriers. Next, employment generation. As foreign direct investment allows to set up its factories in domestic market, so there will be more requirement of employees. Development of human resource. The skill and knowledge of human resource can be improved by way of training. Resources transfer. For example, technology. Foreign technology can be transferred into domestic market by way of FDI. What are the advantages or benefits of FDI? First point, employment generation. Due to FDI, more factories will be set up for manufacturing and services. So it will require more employees. If employee income increases, overall national income increases, more production brings more GDP, and there will be overall economic growth. Due to FDI, there will be lesser cost of transportation, less time will be consumed. Next, human resource development by way of training, knowledge and skill of employees can be improved. Development of backward areas. More factories will be set up in rural areas. The people will get more employment opportunities. There will be education advancement. There will be more transportation facility and overall development of backward areas. Next, increase in export. When foreign business starts its production in India, it will generate more production. There will be more export. If export increases, government will get more revenues. Hence, overall balance of payment position will improve. Exchange rate stability. By way of export, there will be more foreign exchange reserve with RBI. Last, creation of competitive market. Due to FDI, there will be more competition in domestic market, so consumer will get higher quality goods at reasonable price. What are the disadvantages of FDI? First point, disappearance of small scale industries. When multinational corporation starts its business into domestic market, there will be more competition, so small scale industries may not survive. And even multinational corporation brings technology into the domestic market, so there will be technology based production. It means capital intensive products can be produced and not labor intensive products, so skilled person will not get employment. Next, contribution to pollution. When there is more manufacturing units set up in domestic market, there will be more pollution, and foreign companies will start only polluted factories in domestic market. Cultural erosion. When foreign companies establishes its business in India, it will also bring foreign culture. So there will be more Western culture, for example, fashion. Political corruption. Government has established certain rules to reduce pollution, but when foreign companies starts its manufacturing unit in India, it will create pollution, so it will violate the rules and regulations. So they will be indirectly indulge in political corruption. And last, it will bring inflation in the economy. Due to heavy advertising, there will be increase in expenses. So company will try to increase the price of goods and services. This price is to be borne by consumers, and ultimately there will be inflation in the domestic market. What are the types of foreign direct investment? Mainly, it can be classified into horizontal FDI, vertical FDI, and conglomerate FDI. Horizontal FDI means same business, same product. When a business organization establishes same type of business operation in foreign country as it operates in its home country, it is called as horizontal FDI. So, when mobile manufacturer of USA establishes same business in India, it is called as horizontal FDI. Vertical FDI is when company establishes its business which is different from its main business but selling related products. So different from main business but related products. It is called as vertical FDI. And vertical FDI can be classified into backward and forward FDI. Backward FDI is related to inputs such as raw material, and forward FDI is related to outputs. For example, Tata Motor is manufacturing car and raw material to the car is provided by Tata Steel. So Tata Motor and Tata Steel both are different business and providing related product. So it is backward FDI. And next is forward FDI. When Tata Motor is establishing Tata Consultancy Services to look after distribution side. So it is called as forward FDI. Last, conglomerate FDI. When foreign business organization establishes its business which is not at all related to its main business, it is called as conglomerate FDI. Here, the business is not related to the main business. For example, a car manufacturer in USA establishes the new business, that is mobile manufacturing business in India. It is called as conglomerate FDI. Both the products are not related to each other. Next, inward FDI and outward FDI. When a foreign company enters into Indian market, it is called as inward FDI. There is inflow of capital in domestic market. And when Indian company enters into foreign market, it is called as outward FDI. It is also called as overseas direct investment, ODI. So one is inward FDI and another is outward FDI. When foreign company enters into Indian market, it is inward FDI for us. And when Indian company enters into foreign market, it is called as outward FDI. And outward FDI is also called as overseas direct investment. Foreign direct investment is used when another country comes to India, and when Indian company goes to another country, it is called as overseas direct investment. Next, foreign portfolio investment. Portfolio means investment in shares, bonds, and other securities. Foreign portfolio investment means investment in financial assets. Financial assets are shares, bonds, and other securities. Shares can be equity shares or preference shares which are convertible. It means preference shares which can be converted into equity shares after a certain period of time. So, foreign portfolio investment means investment in financial assets such as shares, bonds, and other securities. Unlike FDI, there is no requirement to invest into physical assets. So, there is no ownership and controlling power over business. And this investment must be less than 10% of total financial assets of business organization. It has immediate impact on balance of payment position and exchange rate condition of the country. As the investment is in shares and bonds which are tradable in financial security market, so it is volatile in nature. It means it is speculative in nature. A business organization can purchase and sell a securities in financial market anytime. So there is speculation in FPI. Foreign portfolio investment can be done by non-resident Indians or foreign institutional investors. NRI is an individual person or individual investor, and FII is a group of individuals. NRI is a person who is resident in India for less than 182 days in previous financial year due to employment and other activities. He is a long-term investor or sustainable investor, and FII can be mutual fund AMC or insurance company. Mutual fund asset management company who purchases the shares and securities of different companies for investment purpose, and insurance company. Let's start with the distinguish between foreign direct investment and foreign portfolio investment. First point, in case of FDI, it is an investment in real assets or physical assets of business organization such as land, factory, stocks, etc. And in case of foreign portfolio investment, it is an investment in financial assets such as stocks and bonds, etc. It is investment in land, factories, and inventories in your shares, bonds, and other securities. Next, return on investment. In case of FDI, return on investment is called as profit, and in case of FPI, the return is either dividend or interest. In case of shares, the return is called as dividend, and in case of bond, the return on investment is called as interest. Investment period, FDI is long-term investment and FPI is short-term investment because it is speculative in nature. Withdrawal, it is difficult to withdraw and FPI is easy to withdraw investment. Speculation. No speculation is possible in case of FDI because business organization establishes its factory and business units in another country. But in case of FPI, speculation is easily possible because the foreign company invests into financial instruments which can be easily sellable. Next, technology. FDI brings technology into the foreign company and there is no technology transfer in case of foreign portfolio investment. Next, voting rights. In case of FDI, there is full voting rights available, but in case of FPI, voting rights in the meeting is not available. Ownership and control. There is ownership and control into the business in case of FDI, but there is no ownership and no controlling power. Impact on balance of payment and exchange rate. FDI has no impact on balance of payment and exchange rate because in case of foreign direct investment, the foreign company is considered as domestic company only. But in case of FPI, there is direct impact on exchange rate and the balance of payment. Impact on employment of labor and wages. FDI creates employment opportunity, therefore it has impact on employment, but FPI does not bring employment opportunity, therefore it has no impact on employment of labor and wages. What are the modes of foreign direct investment? FDI can be done by way of equity injection, the simplest way to start new business in foreign country. Next, by way of merger and acquisition, when two companies A and B comes together in partnership permanently, it is called as merger of business. For example, Vodafone, a foreign company, has come up with idea and became Vodafone Idea. It is a kind of merger. And in case of acquisition, foreign company comes to India and purchases the existing business organization. So it is called as acquisition, purchase of Indian business organization. So there are two companies A and B. Company A comes to India and purchases the assets and liabilities of company B and becomes company A is called as acquisition. Here the name of both the companies will be there. Next, joint venture. When foreign company comes to India to run a business for temporary period is called as joint venture. Next, greenfield investment. When foreign company has its headquarter in foreign country and starts its business or starts its subsidiary in Indian market, it is called as greenfield investment. It has a headquarter in USA and subsidiary in India. So it is a parent company who starts its subsidiary company in India. And one more term is there, brownfield investment. When a foreign company purchases the existing facility of Indian company or take on lease. So these are the modes of FDI: equity injection, merger and acquisition, joint venture, greenfield and brownfield investment. Foreign direct investment in India is regulated by different acts such as Security and Exchange Board of India 1992, Foreign Exchange Management Act 1999, previously it was FERA 1972, then Companies Act 2013, the Income Tax Act 1961, Indian Contract Act 1872, Competition Act 2002, and FDI policy issued by Government of India. Next, government authority concerning FDI. So, DGFT, Director General of Foreign Trade, RBI, Reserve Bank of India, Security and Exchange Board of India, Income Tax Department, Foreign Investment Promotion Board, and DPIIT, Department for Promotion of Industry and International Trade. It comes under the Ministry of Commerce and Industry. The minister is Mr. Piyush Goyal. Previously, DPIIT was DIPP, Department for Industrial Policy and Promotion. Previously, FERA was established to regulate foreign exchange and transactions. In the year 1973, only 40% of FDI was allowed. In the year 1991, with the introduction of new industrial policy, that is liberalization, privatization, and globalization, the FDI limit was liberalized further, and after FEMA 1999, FDI was allowed 100% in some sectors. As per World Investment Report issued by United Nations Conference on Trade and Development in the year 2018, India was on 12th position. Later on, in the year 2019, India achieved 9th rank, and in the year 2022, India is on 7th position in terms of world's largest FDI recipient with 81 billion US dollar. The largest FDI recipient is USA, then China, and now India is growing further. Some of the sectors in FDI is permitted and some are prohibited. Prohibited means not allowed at all. Those which are permitted, those which are permitted can be fully allowed or partially allowed, means restricted areas, and both are by way of automatic route and by way of government approval route. So, FDI in India, some sectors are permitted, some are prohibited. Some permitted sectors are 100% open and some are restricted area. It means limited percentage can be acquired. So, and both can be by way of automatic route or by way of government approval. It means no permission is required in case of automatic route and permission of government, RBI or some other institution is required in case of government approval route. The trends of FDI in India has always been increasing. The promotion of FDI in India is managed by DPIIT, which was previously DIPP. It was established in the year 1995 and reconstituted in the year 2000 with the merger of Industrial Development. It comes under the Ministry of Commerce and Industry. The minister is Piyush Goyal. And in the year 1991, with the introduction of new industrial policy, FDI allowed for the benefit of earning foreign currency and overall economic growth. But due to COVID-19, the FDI in India has been fallen. The major investor of FDI in India are Japan with 29%, Singapore with 25%, and USA with 12% in the industry of service sector, especially IT and software products. In August 2021, the Union Cabinet has announced and amended FEMA Rules 2019 to allow 74% of FDI in insurance sector, which is currently at 49%. And in the year September 2021, to boost telecom sector and allow 100% of FDI in telecom sector, which is currently at the rate 49% in automatic route. Routes of FDI. If any foreign country wants to start their manufacturing unit and their business in India, then government has established two routes. One is automatic route, wherein no permission is required. Any business organization established in foreign country can start their business in India in automatic route in some sectors, and government approval route where permission is required. Government permission or RBI permission or other institution permission is required. So in automatic route, 100% FDI is allowed in case of hotel and tourism sector, advertising, films, information technology, B2B e-commerce, airports. Up to 74% is allowed in automatic route. Means if any business organization wants to establish its airport industry in India, then up to 74% of FDI, no approval is required. And these sectors, along with automobile sector, no permission is required at all for 100% FDI. Under government approval route, private sector banking, up to 74% government approval is required. Then non-banking financial corporation, 100% FDI is allowed, but it requires a prior approval of government. Then print media, satellite, telecommunication, up to 49% FDI is allowed under government route, and airport sector above 74% government approval is required. So two routes are available, automatic route and government approval route. What are the unrestricted sectors in FDI? It can be by way of automatic route or by way of government approval route, wherein 100% or less FDI is allowed. So, non-banking financial corporation 100% is allowed. Power sector 100% allowed. Pharma sector 100% allowed with permission. Roadway and highways, hotel and tourism 100% is allowed. In automatic route, advertising and films automatic route 100% allowed. So these are unrestricted sectors. Let's discuss what are the prohibited sectors in FDI. It means no FDI is allowed at all. So first point, lottery business. Next, gambling business, Nidhi company and cheat funds. Next, sectors which are not open for private sector, such as arm and ammunition, atomic energy, railways, real estate business, and manufacturing of cigarette, tobacco, or similar products like substitute products. So these are the sectors or activities wherein FDI is prohibited 100%. Lottery business, gambling, Nidhi and cheat fund. Sectors which are not allowed for private sector is not allowed for FDI also. Real estate business and manufacturing of cigarette, tobacco and substitute products. Let's discuss what are the restricted sectors. Restricted sectors means government approval is required even for 100% or less than 100% FDI. Let's start print media. Up to 26% is allowed by automatic route and above 26 up to 100% is allowed by way of government route. It means if any foreign company wants to start print media in India, less than 26% no permission is required, but more than 26% if they want to establish a business in if they want to establish the business by way of FDI, then government approval is required. Next, satellite. 100% FDI is allowed, but prior prior government approval is required. Private security agency, up to 74% FDI is allowed, but up to 49% by way of automatic route and 49 to 74% government approval is required. It means in private security agency, 100% FDI is not allowed. Only 74% of FDI is allowed, but up to 49% no permission is required, and above 49% but up to 74% government approval is required. Next, telecom sector. Up to 49% by way of automatic route, no approval is required. Above 49%, up to 100% FDI is allowed by way of government approval route. Next, single brand retail sector. Single brand means those business organization who manufactures only one type of product. For example, Dell. Dell manufactures only laptop. So it is single brand retail sector. Here 49% is allowed by way of automatic route and up to 100 allowed by way of government route. More than 49 up to 100 it requires government permission. Multi-brand retail sector. Multi-brand means those business organizations which are involved in manufacturing and selling multi-branded commodities. For example, Amazon, Walmart, these are those business which are selling multiple brand commodities. So up to 51% FDI is allowed but by way of government route. Next, banking. In public sector banking, only 20% FDI is allowed by way of government approval route, and private banking up to 49% by way of automatic route, and above 49 but up to 74% is allowed by way of government route. So banking sector can be classified into public sector banking and private sector banking. In public sector banking, only 20% is allowed, but prior approval is required. And in private sector banking, up to 49% by way of automatic route and 49 to 74% by way of government route. 100% FDI in banking sector is not allowed. Insurance up to 49% is allowed by way of automatic route. Overseas direct investment by India. The term FDI is used when foreign country comes to India to establish business. ODI is used when Indian company goes to foreign market to establish business. So ODI means overseas direct investment, wherein home country India establishes or set up its business in foreign market. So it is called host country. So overseas direct investment, or it is also called as FDI outflow or FDI outbound. Major mode of FDI is by way of joint venture or wholly owned subsidiary. And major Indian business who has set up their business in foreign market are IT based companies such as TCS, Wipro, etc. So modes of ODI is by way of joint venture and wholly owned subsidiary. Investment destination. Major investment destinations for Indians are Mauritius, Singapore, British Virgin Island, Netherlands. Due to tax benefit in the country, RBI data is released every year, every month on the website. By 2022, the ODI was 17.53 billion US dollar. Major investment in UK, $2,000 million, UAE, $492 million, Mauritius, $451 million, Singapore, $399 million, and then USA. of FDI to the host country means what are the disadvantages to host country wherein FDI is inflow. Benefit are the advantages to the host country, cost to home country, and benefit to home country. Let's discuss what are the cost of FDI to the home country. First, cultural interference. Cultural interference means, for example, beef products are considered to be taboo in India. Next is political interference. For example, corruption. If manufacturing plant is a pollutant, then political party may indulge in corruption. Next, due to high competition, the domestic industries may not survive and threat to the local producers. There can be overutilization of resources or exhaustion of resources such as oil products and all. What are the benefits to the host country? There will be employment generation, more government revenues, infrastructure development, technology transfer. If if new political party come up with new FDI policies, then there will be risk. Next, reduction in domestic investment. If business organization invest money in foreign market, then there will be lesser investment in domestic market. There will be lower employment in domestic market, and it will not contribute to the GDP of nation. Next, benefits to home country. There will be access to new market, access to new resources, new opportunities in foreign market, and there may be possibility that cost of production will be less. So these are the cost and benefits to the home country and host country.